Guys, I was thinking about making a personal video face to face about investor mentality and why do some investors thrive while other panic sell or panic buy. If you want to succeed in the stock market, you need to know more than just the stock price. You need to know more than just the fundamentals. You need to have the right mindset. So let's look at the psychology behind investing. You can categorize two different kinds of mindsets when it comes to investing: short-term and long-term thinking. Both ways of thinking have different kind of risks, and both kind of thinking will create different kind of results. So making the choice between these two kinds of thinking can be kind of hard for an investor, and it kind of depends on your financial goals and risk tolerance. So if you look at the long-term thinking or mentality, you have compounded returns. You look at famous investors like Warren Buffett and Harry Smith and how the business is the focus. This is mostly the line I move with when I'm investing. I want to have a quality business. I want to have price in my favor. Well, sometimes it turns against you. I like the reduced transactional costs of not having to leave the investment and find another one, because then you have to find another business that's equally as good at the same cheap multiples or cheaper. This way of thinking also reduces the amount of stress. I don't feel as anxious or stressed because of the way I'm thinking about my investments, even though I want to highlight the one thing I put stress on is where and how I start my holding. So for me, the most important part about investing is when and where to buy and what to buy. But you also have the downsides when you have this kind of thinking, that the market moves in cycles. And you will notice this if you're a long-term investor. There will be years like COVID when your portfolio will drop 30 to 50%, and you will start to question yourself if maybe you should have sold and bought back. And this is why I like to highlight the mentality of trying to buy when a company's stock price is in an uptrend, because then you're not buying into a potential trap. Because a lot of people, even if they bought good companies in start of COVID before it became big headlines, panic sold at the bottom. And that's the reality. It's a mental game. Investing is a mental game. When you look at long-term investing, you also have to look at business risks. And I think a lot of people ignore this. They like to highlight the sunny side of businesses. They don't like to highlight why this company will suffer in bad times. Some companies thrive in bad times. They can increase their prices while others can't, and they will lose market share when they come out of the bad cycle. Or they might be a technology company that's set up for disruption, or management might mismanage the invested capital and the investor won't see enough returns into the future. So it's a very mental game of understanding the business, the management, and the future prospects. Okay, so let's look at the short-term investor mindset. It's often associated with trading, buying, selling, or shorting assets with a very day-to-day mindset, just capitalizing on price movements, basically. Relying heavily on technicals rather than understanding the business they get into. So the advantages with a short-term mindset is you can have quick profits. Normally they are smaller profits, but quick profits. You are more flexible. If one area doesn't work or one business has issues, you're more flexible. You're more adept to just selling your position and moving out. While a long-term investor that has built up confidence over a long period might struggle to sell his conviction, and you have a better way of reacting to information faster, while a long-term investor don't really act on daily information. So then you have the challenges of short-term mindset. You have higher fees, higher transaction costs, a lot more stress. You're more worried about what the market will do today and tomorrow rather than what it will do in the next 10 years. And you have a statistically disadvantaged mindset. This is just facts. Most short-term traders struggles to turn a profit and to consistently beat the market, but majority of long-term investors don't beat the market either. So what does that tell you? Maybe ETFs is the way. Buy VTI, be happy. Buy WU, maybe. So I would say this, just looking at these two options, I would say buying an ETF is something everyone should consider before they start to learn about investing, because it's a great way of benefiting from the long-term success of the market, and it's a more comfortable way to invest. I also want to cover the fear of missing out, or like most people want to call it, FOMO. I would say today the latest FOMO is Tesla. I saw a lot of people buying it in the high 400s, even though it was clear it was going to go lower. I don't have anything against people buying Tesla. You have your own conclusions. Don't buy against the market. That's rule number one of investing, is don't lose money. Whatever you do, short-term, long-term, don't lose money. And if you're a long-term investor, don't think about it like, oh, I lost money this year. Think about it, will I make money in 10 years, in a 10-year window, if I buy this? Can I see myself holding this for 10 years? Always stay rational. This is something hard, especially when CEOs, YouTubers try to push a narrative. Like, you need to see the correct opportunities. Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy. But I would actually adjust that to when others shift from fearful to greedy, start being greedy. Because if you buy into fear, you never know when the fear stops. And when you buy into greed, you never know when the greed stops. So yeah, don't be greedy. I guess that's the highlight of fear of missing out. If you're greedy, you're going to lose money. Because everyone is saying this company will 10x in the future. It doesn't mean it will make you money this year. It could collapse, and maybe they're wrong, and you took some bad advice. So let's talk about independent thinking. The market moves on narratives, but most of the time people are wrong. So when a strong narrative comes into a company, the narrative is wrong, you will see a collapse in the stock price. If you're just following the latest hype, whatever meme, AI, or short-term big new thing, you're not really investing, you're speculating. You need to build up a system on how to do your own research, how to build conviction, and stick to your principles. I think Peter Lynch says this best: know what you own and know why you own it. And with that comes risk management. Risk management is, in my view, everything for an investor. Even the best investments can be wrong sometimes. For example, I have a majority of my money in PayPal, and currently it dipped like 10%. But I also foresaw this correction. And when I see something is about to move in the opposite direction, I have to ask myself, will this make me more money in 10 years than I've made this year? And if you've seen my previous videos, I think I was up 44% last year. So of course, you feel worse when you see your gain of 44% retract to 38. But you have to ask yourself, is it worth selling it if you're gonna hold it for 10 years and see a potential profit on it? And I have to say this, even great investors, even me, get stuff wrong. But the difference is most investors don't bet everything on one stock. They diversify and understand the risks of the businesses they own. If a single investment can wipe out your yearly return, maybe you shouldn't be in it, because then you're not really investing, you're gambling. So let's cover patience and consistency. The market rewards the investors who can endure time. Everyone probably heard about compounding and its power. Over a long period of time, compounding will increase your returns, but it takes time. If you expect to double your money in one night, you're setting yourself up for disappointment. Instead, focus on being consistent. Focus on being intelligent when it comes to your investments. Having small gains is nothing to be ashamed of. If you create small gains year after year, you create exponential growth. As Charlie said, the money is not made in the buying or selling, it's in the waiting. So if you watch this far, good. But now I'm going to compress it. Make informed decisions based on logic. Accept what cannot be changed and focus on personal growth. Seek lifelong, cultivate a clear perspective on your investments. You will face adversity in whatever you do. You will face criticism in whatever you do, but stand by your values. Don't panic and despair. Embrace change. Learn new things. I think that's one of the Charlie Munger quotes. Charlie Munger said, "I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines." So yeah, if you stop learning, you're not going to be a good investor. And I would say if you start out and you're not already rich, I would tell you to avoid material pleasures and know that you have enough. And I think a lot of people don't realize they have enough. They think they need more. That's also combined with understanding your impulses. If you don't understand your impulses, you will make irrational decisions. You will waste your money, and your money is your tool to create wealth, to create a better future for you and your children. So it's important in life to have a balance. You need to work, you need to rest, you need to have leisure. So you need to embrace the individual you are and understand your flaws. What is your investor mentality? Do you think long term? Do you think short term? Are you somewhere in between? Maybe you have two different portfolios. I would say I'm 50-50. I have one portfolio where I have investments that I'm never going to touch. And I have one portfolio where I have investments that are great long-term opportunities, but I have identified the risks and I'll follow that and see if the risks increase. It's more tax efficient in that portfolio, so I can leave that investment whenever I feel like it's getting too uncomfortable. So how are you managing risk? Are you staying patient? What's the biggest lesson you have learned as an investor? Comment down below. Thank you.